Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 23rd of March. I'm Daniel Lam, your host for the podcast. The FOMC was not the only game in town last week. The other two major DM central banks, the ECB and the BOJ, also had their interest rate decisions meetings. Both of them kept rates steady, but it is interesting to take note of what they discussed, especially under the current uncertain macro environment. Now in Europe, the higher energy prices complicate the outlook for inflation and growth. Now the ECB left rates at 2%, but revised its forecast. The December projections looked at inflation undershoot, but forecasts now see both headline and core overshooting. GDP growth got revised lower. However, the ECB signaled that it was not so concerned yet about recessionary risk, citing low unemployment, strong private sector balance sheets, and public spending on defense, as well as infrastructure supporting growth. Now, growth has been more resilient than expected in 2025, but there was a lack of momentum. Sentiment was just lukewarm prior to the Iran escalation. And now, with the elevated energy prices, the early March data is pointing to a sharp deterioration. Now, it is too early to say whether the ECB is going to put more emphasis on controlling higher inflation or to support growth. Similar to the Fed, the policy path of the ECB really depends upon inflation expectations. Now, in contrast, there was a hawkish tilt at the Bank of Japan meeting. The BOJ held rates but kept the door open to future rate hikes, despite the shock from energy prices. The policy rate was left at 0.75%, with Governor Ueda signaling that a temporary energy shock should not derail the underlying upward inflationary trend. The BOJ maintained its tightening bias with a potential hike as early as April. Now, Japan continues to be a special case amongst the developed markets, since it is already in a hiking cycle with accelerating growth momentum before the conflict in the Middle East. Japan is directly exposed to the Hormuz situation, given its reliance on energy imports from the Middle East. So its medium-term inflation and yields should rise regardless of the situation there. Continued tensions will lift supply-side inflation and partly offset domestic price pressures through lower growth, while a quick resolution would resume the strong domestic momentum. Thus, there is a good possibility of a potential short squeeze in the yen, and dollar-yen can turn south and retest the support level, such as 153, upon de-escalation in the Middle East. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.